Okay, so far, guys, we have looked at very important principles of financial management, and there are three basic principles that we were looking at. Okay, so investment principle, financing principle, and dividend principle. We're going to have a brief review of what we have discussed so far. We said that these are three fundamental principles that guides decision-making as regards the financial function is concerned. Number one, investment principle, okay? And the principle here is that a company should decide in what projects the company should engage in. So whether it's the mother company, let's say a mother company, let's say Ayala Corporation, the mother company will decides in which industries the company will invest in, or if it's just the SBU, the strategic business unit. For example, in the case of Ayala Corporation is the mother company, and then BPI is an SBU, strategic business unit. So the decisions made by these two entities are different. The mother company decides whether in what industries the company is supposed to engage in, while on the other hand, the SBU decides which projects, which investments related to the business entity a company should invest in. So decide what projects or acquisitions to invest in, and of course, the decision rule whether the company should engage in that project is based on certain parameters. If it's okay, I think we discussed this last time. Okay, if the projects are mutually exclusive, which means the choice of one negates the other, then we choose the highest internal rate of return. Okay, in this case, by way of review, guys, the highest internal rate of return is 15%. So we choose project A. However, there's a caveat for that. This return, this IRR, should be greater than the weighted average cost of capital. Okay, if it's not greater than the weighted WACC, then it should be rejected. Okay, and we defined WACC to be the average cost of acquiring funds, and it's inclusive of all the sources of funds: debt, equity in the form of common stock, and equity in the form of preferred stock. This is to be weighted. Okay, this is to be weighted. That's why we have the weighted average cost of capital. It's averaged, and it's average using the weights of the contributions of the different finances. So we had an example before. Debt is at 20, common stock is 20, debt is at 10, common stock is 20, and preferred stock is 5. The weight can easily be computed. Debt will be 10 over 35. That will be the weight of the debt. Common stock will be 20 out of 35, and preferred stock will be 5 out of 35. So that easily computes for the weights. What's difficult to compute, guys, is the cost. Because generally, the cost of the debt is cheaper than the cost of common stock or the cost of the preferred stock. And this is consistent with the principle of risk and return, because shareholders, particularly common shareholders, assume a greater amount of risk as far as financing is concerned. So to be consistent with the principle of the higher the assumed risk, the higher is the required return, the cost of common stock in particular should be greater than the cost of debt. Why do shareholders, particularly common shareholders, assume a greater amount of risk? The reason behind that is that in the event of liquidation, when the company folds up or becomes bankrupt, the process is the company sells off its assets to convert it into cash to pay off their financiers. Okay, so the first to be paid are the creditors. The last to be paid are the common shareholders. After the creditors, the preferred shareholders will be paid, and then if there's any amount left, then that will go to the common shareholders. So in that regard, guys, common shareholders assume a greater amount of risk. Thus, the cost of financing from common shareholders will be more expensive because they will demand a greater amount of risk. All right, so that's what we mean, guys, by of course, if the projects are independent, then it doesn't matter, guys, if you choose several of this. What the constraint will just be on the budget allocation of the company. Okay, so let me go back here. That's what we mean by earning the highest possible risk-adjusted return. When we say risk-adjusted return, it takes into consideration the cost of all the finances, the cost of debt, the cost of equity, and the cost of common and preferred. And by the way, I forgot to once again review this. Notice that the cost of debt is netted against the tax. So if the tax rate is 30%, therefore the contribution of debt to the WACC will only be 70% of the weighted cost. Okay, why do we subtract the tax? Because the use of debt affords the company with tax savings. Okay, so with the tax savings, guys, there is a reduced cost of debt. Okay, so okay, hold the line, guys. Let me just close the door because the dogs are noisy. Okay, sorry about that. Okay, so after the capital investments, we have capital financing. Now, it's important for the firm, of course, the acquisition of funds. If the company is not liquid, it means it's not able to source funds. Then perhaps finance is not doing its job, because that's the role of finance, to be able to ensure that the company has enough liquidity in order to sustain its operations, whether it's for a short-term investment or a long-term investment. Okay, and of course, how to fund the capital investments, either by debt or by equity, and also to optimize the mix. The mix should be in such a way that it maximizes shareholder value. And thirdly, again, guys, when the company is faced with this situation where it does not have enough projects to invest in, which means the projects are not that viable, the estimated return does not exceed the hurdle rate or the weighted average cost of capital, and it's important for the finance group to determine whether they should return the money to the shareholders in the form of dividends or in the form of buying back the shares of stock. That's very important. Dividends are important because it sends a strong signal to the market, especially if the share is being traded in the market, that this company is performing well in the sense that it's able to generate excess cash to distribute to the shareholders. Okay, so that's why in say, for example, in the Philippine Stock Exchange, there are what we call blue chip companies that regularly pay dividends. Okay, they pay dividends, and it's a signal that these companies are able to generate excess cash, excess returns in order to distribute to their shareholders. So these are the three very important functions of finance: capital, investment decisions, financing decisions, and the dividend distribution decision. Okay. Okay, so the first principles, this is just a review again, guys. For first principles, let me just recapitulate. For the investment principle, okay, we're saying that the business finance should be guided by investing in assets and projects that yield a greater return greater than the minimum acceptable rate. Ergo, guys, the IRR, okay, should be greater than the weighted average cost of capital. The estimated internal rate of return should be greater than the WACC. Or we said that another measure that we can use is the net present value of the project should be greater than 0. It should be positive. Any project where the net present value is negative should be rejected. Okay. The hurdle rate, as I mentioned a while ago, should reflect the financing mix. So that indicates, guys, that when a company invests in a project, okay, or when the company is looking at investing in a particular project, in order to determine if that project is feasible, okay, it should make use of the WACC, okay, which we know is the is the weighted average of the different costs of financing. Okay, even if, for example, the project, let's say it's 100 million. Let's say that the project will be financed by debt. Okay, the total 100 million. Even if the project is to be financed totally by debt, still, what the company should use for determining if the IRR is feasible or not is it should still use the WACC and not only the cost of the debt. Okay, I hope that's clear. So, for example, the company will engage in a 100 million project, and the funding will be sourced, a majority of which will be from debt, a borrowing of, let's say, 10%. Okay, even if this project will be financed through debt of 10%, okay, we still need to use the WACC, the weighted average cost of capital, in as far as computing for the IRR. Okay, in the course of this subject, we'll learn how to compute for the IRR, and there is a need not to only use the cost of debt. It has to be, it has to involve the financing mix, both the equity in the form of common stock or preferred stock. Okay, so that's the message here. Okay, even if, as I said, for the nth time, even if the project will be wholly financed by debt, by borrowing from a bank, for example, still, when we compute for the return of the project, we have to use the weighted average cost of capital. Okay, let me pause for a while, guys. Is that clear so far? Pakichat naman kung clear yung discussions natin dito about investment principle. I would appreciate any feedback from you. Okay, if I'm getting across you guys. I hope more will respond, guys. I only have 5 responses so far, and there are 28 all of you in the class. How about the rest? I'll appreciate any feedback from you. If you have questions, please feel free to raise your hands or interrupt me. I will appreciate any questions from your end. Okay, so let's wait for a few more responses from the class before I proceed. Okay, let's, I hope I get at least 20 responses. Okay, waiting for a few more responses, guys. So again, back to my question. I hope the discussion on the first principles on investment principle has been clear so far. Okay, thank you. Thank you. Thank you for the responses. Okay, then now, what's also important is that when we consider the investment principle, I'm going to discuss this in a while. There should be what we call, it's important to look at the magnitude. Not only the magnitude, but the timing of the cash flows. I'll discuss this in greater detail in a few minutes. So notice that here the discussion revolves around cash flow. Okay, when we identify a particular project and assess whether that project is feasible or not, we use cash flow. We compute for the cash flows. Notice it's not the net income after tax that we use. We don't assess the project based on its net income after tax. And for the primary reason that we know that cash, the money is really the prime mover of any transaction. When you borrow from the bank will lend you not net income, the bank will lend you money. And the bank requires money back in return in the form of interest and principal payments. Okay, so is net income after tax not needed? Well, it's needed in the sense that we can use this in order to compute the cash flow. We use the net income after tax as a springboard to compute for the cash flow. Okay, and not only do we look at the magnitude, we'll also look at the timing of the cash flows. When will we have these cash flows? Is it 10 years from now? Is it 20 years from now? So those are very important questions or parameters that we need to look at. Okay, next is the financing principle again, by way of review. It's important that the business, finance in particular, that's their role, acquire financing for any project. Okay. Financing strategy is essential to the continuity of the business over the long term because financing strategy involves acquisition of funds. Okay, and it's important to determine what's the optimal financing mix, the mix of debt and equity. So it's not only the right mix. Okay, so let me write that here. It's not only the right mix. When we say mix, we're referring to the capital structure, the balance, the percentage of equity, and the percentage of debt. It's not only the right mix, but also the right match. Okay, what do we mean by the right match? By the right match, we mean that any long-term asset should be financed by by what, guys? Long-term financing. Okay, it's unthinkable, guys. It's very absurd to borrow, let's say, or finance a project worth, let's say, 500 million. Okay, this is a 10-year project, and we're going to use the credit card to finance this. How in the world? Okay, how in the world should this happen? Credit card, guys, payable in next month. Okay, so this is very absurd, guys, because this is a long-term project. This is a long-term asset, and it should be financed by long-term financing. Matching 10 years with 10 years, perhaps, a 10-year debt. Okay, so that's what we mean by the right match. Normally, guys, a short-term asset should also finance by short-term financing. Okay, so inventory, for example, you don't take a loan for 10 years to finance your inventory needs for this year. If a company, for example, has to have 1 million worth of inventory in order to to support their sales forecast, then you don't borrow inventory at 1 million for 10 years. Okay, we don't do that. Normally, there are trade payables. It's a support of the suppliers, or if we need short-term borrowing, then there are instruments that allow us to borrow for the short term. Short-term assets, short-term financing. Sometimes short-term assets is financed by medium-term financing. Sometimes that can happen, but generally, there should be the right mix and the right match as far as financing principle is concerned. Okay, again, another question, guys. Is this clear so far? Yung right mix ng debt and equity at saka right match. Okay? If you're a business owner someday, tingnan nyo dapat yung ginagawa ng finance people nyo. Okay? There should be a proper matching of the assets with the financing. Okay, back to my question, guys. Clear so far? Okay. Chat, please. Okay, thank you. Thank you. Sana, guys, I wish that next time if I ask for your responses, it will be okay. It will be really everybody responding and quicker yung response. Okay, so let's continue, guys. Okay, so this is what I was mentioning a while ago. Finance plays a major role in that they should ensure that there's a constant inflow of capital. Okay, it's important. Liquidity is very important. How can a business continue if it does not have sufficient funds for their operations? Okay, no funds for inventory, no funds for raw materials. How can you support the sales? How can you generate the revenues that the company needs if there, in the first place, are no raw materials in order to produce? the final product of the company. So that's a very important role of finance, the acquisition of funds, the getting of the funds, okay, in the right way, in the right mix, and in the right match. Okay, so that's a critical role of finance. And lastly, guys, again, the dividend distribution. This has got to be one of the most important decision of finance, dividend decision. If there's excess cash, should the company pay it off as dividends to the shareholders, or the company can buy back the shares? Okay, when we say buy back, it's actually treasury stock. The company themselves buy it back from the shareholders, and there's a reason for doing that, which we're going to discuss in the near future. Okay, so this is a very important decision. Okay, if there's not enough investment which earns the company greater than the hurdle rate, then it's wise for the company to return the cash in the form of dividends. Because as I said, dividends have their role. Okay, it sends a very strong signal that the company is awash with excess cash, that they can still support their operations and at the same time return cash in the form of dividends to their shareholders. So in whatever form that will be, whether dividends or stock buybacks, it will really depend on what these stockholders prefer. Okay, so again, guys, in a nutshell, what's the principal role of corporate finance? At its very core, it's employment, okay? Employment of funds. Now, when we say employment of funds, guys, when we say employment of funds, we mean, okay, the acquisition of these funds. How do we get these funds? And of course, the use of the funds. So acquisition pertains to financing and the use of the funds pertain to investment. Okay. So without the acquisition, guys, how can the company support its operations, its goals, okay, its long-term forecasts? How can the company support its sales forecast if the company is not able to get financing for its short-term assets and long-term assets? Assets are very important, guys. We know that assets are the resources that the firm needs in order to be sustainable, in order to exist. Okay, but assets, you don't get assets from just from the side street. Okay, assets are, the company has to find the right assets for the company. Okay, and the right assets require that the company, the right assets should be financed properly, and it should be used also properly. Okay, and of course, the third one is the dividend decision, which means that the company can reinvest or distribute any of its profit, okay, to the shareholders. Now, just a few seconds, guys. Okay, sorry guys. All right, so back to my discussion here. So at the core of corporate finance is the employment of those funds, and also the decision whether to reinvest or distribute any subsequent. This should be cash flows. Okay, sorry for this. Instead of profits, it should be cash flows generated. Okay, so again, guys, this is just a big picture. Whatever decision the company decides in as far as the investment or financing or dividend decision, the objective should be to maximize the value of the firm. Okay, so for the investment decision, the company has to acquire assets. Okay, the company has to come up with projects where the returns is higher than the weighted average cost of capital. Okay, when we talk of the hurdle rate should reflect the riskiness, okay, we talk about the riskiness that is reflective of the WACC. Okay, so this is the summation of wiki. Okay, the riskiness, guys, is measured by the cost components of the different financing schemes. Okay, weight of debt times the cost of debt times. Okay, so sorry, my digital pen is 1 minus stocks plus the weight of the common stock times the cost of the common stock plus the weight of the preferred stock times the cost of the preferred stock. So we sum everything up. Okay, so the riskiness there is reflected here in the different costs. We said that debt is usually cheaper than the cost of the common equity or the cost of preferred equity. However, by law, guys, you cannot just use debt because a corporation, guys, has by the way this corporation operates, there has to be contribution coming from the shareholders. Okay, so riskiness and also the mix of debt and equity, so that's taken care of by the weights. Okay, the mix of debt and the mix of equity. Now, for this one, I mentioned this a while ago, the return should reflect the magnitude and the timing of the cash flows. Okay, so let's have a hypothetical example. Let me pause for a while, my chat dito. Okay, thank you. That's just a while ago. Okay, suppose we're going to have an investment, okay? Project A, okay? Project A, and the estimated cash flows are the following. So we have here for year 0, year 1, year 2, year 3, year 4. Okay, for year 0, the initial investment is 1,000. Okay, for year 1, it's estimated that the cash flow will be 500, 400, 300, and then 400. Okay, so this is the cash. These are the cash flows of this project A. Okay, take note, I said cash flow. Okay, so my question is, I want you to write your answer in the chat box. Everyone, please. I just want to get your opinion. So let me explain further again what this is all about. So the company would want to engage in project A, and the initial investment is 1,000. After 1 year, the company will get a cash of 500. On the second year, 400. On the third year, 300. On the fourth year, 400. Now, could you kindly chat in the chat box? Type yes or no. Yes, if you say that the company should invest in this project A. No, to say that the company should not invest in this project A. Okay, let's have 1 minute for that, guys, for you to think and for you to write your answer in the chat box. Okay, so what's your answer, guys? Kindly chat in the chat box. Just a yes or a no. Okay, I'll just write here a line to indicate that the answers are after this line. Okay, let's have a few more seconds, just 20 more seconds, guys. I want to see your answers. So everyone, please. Just a yes or a no, guys. I'm only getting one answer. How about the rest, guys? Okay, 10 more seconds. Okay, thank you. Thank you for your responses. Okay, so let's see. Thank you for 11 answered. Okay. Okay, let's see. Would like to volunteer and explain. So most of you answered yes. Okay, thank you. Thank you. Anyone who'd like to volunteer and explain and venture to explain why he answered yes? Because I see here 100% of you answered yes. Anyone? You may unmute yourself. Okay, so let me call Louis. Louis, Mr. Buwan, why do you think that the company should invest here? Hello, Louis. Hello. Okay, not sure. Okay, thank you, Louis. How about James? James, would you like to explain why you answered yes? Okay, take a look at the cash. This is cash outflow. This is the initial investment. And then these are the cash inflows. Okay, Charmaine, thank you so much. Yes, Charmaine.
Sir, I'm not sure if my explanation is right, sir.
It's okay. It's okay. No problem. No problem.
For me, sir, I answered yes because diba, sir, the initial investment would be 1,000 pesos, sir.
Yes.
And I saw naman po within 4 years, the one parang nabawi po, sir, yung 1,000
Yeah.
and they actually
Okay.
made more po.
Okay. In what year will the company be able to recover their investment?
By the first half po of year 3 po.
Yeah, correct. No, so Charmaine is very, very correct there. By the first half of the third year, yeah, because on the first year it's 500, so they were able to recover already 50%. On the second year, they got already a total of 900. On the third year, that a total of 1,200. So that means that on the third year, they were able to recover the whole amount. Okay, Charmaine, please remind me you get +2 points sa short quiz natin. Okay, thank you for answering. Okay, Charmaine is correct. So Charmaine offered this answer that this is sound because the company was able to recover everything, no? The initial investment. In fact, on the third year, the company was able to recover already the initial investment of 1,000. Okay, so now from a finance perspective, okay, since we're studying finance, we would like to know how finance will determine whether this is feasible or not. Now, I already gave you the answer before, and we can make use of the concept of the IRR. Now, we have to compute for the IRR, the internal rate of return of this project, and then compare it with the weighted average cost of capital. Okay, if the IRR of this project is greater than, let's say the IRR is 11%, and the WACC is, let's say, 12%, then what would be our decision? Our decision would be to reject this project. Okay, since the IRR return of the project is less than the weighted average cost of capital. Okay, now, but since we haven't learned how to compute for the IRR, and there's a locking given here in order for us to compute for the IRR, then we go to the other way in order to determine whether this is feasible or not. So we said, guys, that capital budgeting techniques dictate that the two most popular ways to determine whether a project is feasible or not is via the use of IRR and via the use of NPV. Okay, so how about the NPV? Now, the NPV, guys, will make use of this. It will take into consideration the magnitude and the timing of the returns. Okay, the magnitude is here, guys. It's 1,000, 500, 400, 300, 400. So in order to determine whether a project is feasible or not, we have to identify the cash flows. Okay, no cash flows, guys. no determination whether the project is feasible or not. Okay, we cannot determine whether the project is feasible or not. Okay, so we have the magnitude of the cash flows. Now we have to make use also of the timing of the cash flows. Okay, the timing of the cash flows. Now that's very, very important. Okay, the timing of the cash flows. Notice that here the cash flows are placed in such a way that we know when the timing is. Okay, so let me pose another question. What would you want, guys? 1 million today or 1 million after 1 year? So could you kindly chat, guys? Today or after 1 year? If you're going to be given 1 million, when do you want to get it? Today or after 1 year? Would you kindly chat, please? Today. Okay, today. Thank you. How about the others, guys? Okay, today. Okay, so I have several answers, guys. Let's say today. Justin, why today? Why would you want the 1 million today rather than after 1 year?
I just like instant money, sir.
Instant money. Okay, and also, Justin, isn't it right that if you have 1 million today, you can put it in an investment, and then after 1 year, get that investment,
Yes,
assuming
sir.
that the return will be higher than, will be positive, then you'll have an amount which is greater than 1 million, right?
Yes, sir.
That's correct. So that's very, very basic, guys. That we would want the money today compared to what the same money after 1 year, because as I mentioned, money will earn interest, and as the money grows interest, the interest will also gain interest. So interest on interest on interest, and after the term, after 1 year, you can get an amount higher than 1 million. Okay, so the timing of the timing of the cash flow is very important. Now, what we did a while ago was to add this. We said that this project is okay because 500 plus 400 plus 300 plus 400, that's 1,600, and that's greater than 1,000. Okay, now that's the way to answer it. Okay, if we have not been made aware of the principles of finance. Now, what's very important here is that the timing plays a major role, and thus we cannot add 500, 400, 300, 400. Okay, that's because that will violate what we call the time value of money. 500 now is not the same as 500 after 2 years. Okay, so that's what we call the time value of money. So how do we now answer this? What we have to do, guys, is to peg these values on a constant time frame. So what we can do is convert 500. Okay, so how much is 500 1 year from now today? How much is 400, which we will get 2 years from now? How much is it today? How about the 300? How much will it be today? And the 400, guys, how much will it be today? In other words, we can compute, we can convert all these future cash flows into its present value. So let's call this present value 1, the 400, we call it present value 2, the 300, we call it present value 3, and the present value 4. Okay, so these are the 4 present values. Now, when we have converted all of them into present values, we mean we find the value now, we can now add it with 1,000. Okay, so we can now add them because they now belong to the same time frames. Okay, so let's suppose for purposes of example that the sum of these present values, the sum of all of these are equal to 1,200. Okay, so I'm finding a space to write 1,200. Okay, only for purposes of example, guys. Let's assume that we converted these cash flows into their present values, and then it adds up to 1,200. Now, the initial investment is 1,000. Can we add them now? Yes, guys, because they now belong to the same time frame at time 0. And we see, guys, that the present value of your future cash flows, 1,200, is greater than the initial investment of 1,000. So if we sum them up, we get 200. And that's what we call the net present value. Okay, net present value. So if the net present value is greater than 0, in this case, it's 200, then the project is okay. We should accept the project. Now, for purposes of this example, we said that IRR is 11%. and it's less than the WACC. So in terms of IRR, we're rejecting the project. Reject the project. But in terms of NPV, we accept the project. So there's a conflict between IRR and NPV. So which do we follow? Okay, from the finance concept, we always follow the NPV. Okay, later on we'll learn how to compute for the IRR, and we have learned actually how to compute for the NPV. And the NPV is the more theoretically correct way of computing for the returns of the project. Okay, so when there's a conflict between IRR and the NPV, always choose the NPV. Okay, we'll learn how to compute for them later on as we go along. Okay, so I hope, guys, this is clear to us. Okay, the riskiness and the mix of debt, that accounts for the using WACC to compute for the returns, and also the magnitude and the timing of the returns, we make use of the NPV, the net present value. Yes, we have to compute for the estimated cash flows, and yes, we have to consider the timing of the cash flows. Okay. All right. Quickly now we go to the financing decision. I'm pacing my time because we would want to finish all the slides. Okay. Okay. Let me just do a time check. Okay. I'm sorry. Okay. We have around 20 minutes. We can finish this. Okay. How about for the financing decision, guys? Okay. We discussed this a while ago. We have to have the company has to acquire funds, okay, employ these funds. We say that it's very important to know where to acquire the funds and make sure that the financing mix is the one that maximizes shareholder value, and also that the financing there should be a right, not only a right mix but also a right match. The right kind of debt should match the tenor of your assets. Short-term assets should be financed by short-term debts. Okay? Long-term assets, if we're going to use debt, it should be financed by long-term debts. Okay. And thirdly, guys, a dividend decision. Okay. If the company cannot find investments where the returns is acceptable or greater than the weighted average cost of capital, then it's better for the company to return the cash to the owners of the business. Okay. Now the question is how much cash. So this is a very important decision. How much of the profitability of the firm should be returned to the company, to the shareholders, I mean. So if you take a look at the net income after tax, okay, we have to take a look at, there are two ways that we can use this. Either flow it back as retained earnings. This is retained earnings, guys. It means that it's used for the operations of the business, or returned as dividends. Okay, so the ratio, okay, we call it DPO. That's a dividend payout ratio. If the company decides, for example, that from the profit, 10% will be distributed as dividends, then of course the 90% will be flowed back to operations. So this is what we call the dividend payout ratio. Now that's very important. How much cash you return. Okay, it depends, of course, on the potential investments. If the company sees that there will be potential investments in the near future, then perhaps the company would, in their shareholders meeting, tell the shareholders that at this time we're not going to return dividends because there are some very good projects in the pipeline. Okay, so of course the shareholders, unless they are able to identify some projects that will earn greater, then of course they can pull out their investments in the company, sell it in the stock market, and put their money elsewhere. Okay, they're at liberty to do that. Okay, so there are two choices, whether to return the cash as dividends or as buybacks or paybacks, which means the company will buy back the shares from the shareholders. We'll seek to address why a company would buy back their shares in the future. But of course, you can research ahead of time why companies buy back their shares from the shareholders. Okay. Okay, so this is just a repeat of what we discussed. Okay, whether it's investment, financing, or dividend decision, the objective should always be to maximize the value of the firm. Okay, so there are some very important corollary principles. Okay, so these are 5 principles that we need to look at also. Number 1 is that cash flow is king. Okay, any assessment of any particular investment should be decided by the estimation of cash flows. You know this, guys? The flow of funds is always denominated in cash. Okay? No shareholder, no creditor will lend something else. It's always in cash. So here, cash flow is really king. Okay, and shareholders, creditors would want their investments to be returned back to them in the form of cash. Okay, also we looked at the time value of money. Okay, 1 peso today is not the same as 1 peso 10 years down the road. We would want to have cash now compared to 10 years down the road. And the principle of risk and return, we discussed this in some detail before. The higher the assumed risk, the higher is the required return. And also this one is very important. I'll discuss this in a few minutes. The efficient market hypothesis. Okay, let me postpone our discussion there in another slide. And then of course we have the ever-present agency problem. Okay, so let me take a look at this. And as far as cash flows is concerned, guys, it's bigger is better. Okay, of course we would want the cash inflow. We would prefer a cash inflow of 100,000 as compared to 2,000. Okay, the bigger the expected cash inflows, the better. Okay, as far as timing is concerned, the sooner the better. It's better to have the 1 million cash inflow after 1 year as compared to 1 million after 10 years. That's very practically true. The timing of the cash flow stream sooner is better. And of course, in terms of getting the cash flows, in terms of its riskiness, the less risk, the better. Okay, so these the very basic principles as far as cash flow is concerned. The bigger the cash inflow, the better. The sooner we get it, the better. And then the less risky the cash flow is, the better. Okay, so just to highlight this point, cash is king. What does it mean? Firstly, guys, accounting profit is not the same as cash flow. Although profit is important, we only use profit, guys, in order to determine the cash flow. Any project we look at, we do not use the accounting profit as a basis for computing whether the returns are feasible or not. Okay. Of course, we know that it's cash flow that drives the value of the business. Okay. And then later on, when we go into capital budgeting, we're going to look at the concept of incremental cash flow. And incremental cash flow is what's needed in order to making financial decisions. I'll postpone, guys, the discussion of incremental cash flow for the future. Okay, second principle, the time value of money. And what have we learned about the time value of money? 1 peso today is worth more than 1 peso 10 years from now, because we know that interest on money can earn more interest. Okay, it's better to receive money now than 1 year from now. Thirdly, we have the risk and return principle. Okay, no firm will take on additional risk unless they are being compensated with additional returns. So this is just plain and simple common sense. Okay, so let's take a very brief classic example or simple example. We have Globe, let's say Globe, and let's say a newcomer in the market, Dito. Okay, both of them will engage in a project, let's say for 500 million project, 500 million project. And they say that this project will be 10 years, payable in 10 years. So they're both going to issue bonds. So what's a bond, guys? A bond, okay, is an instrument. It's like an IOU, mangungutang. No? So when we say treasury bond, it's the government that's borrowing money. When we say corporate bond, it's the company that's borrowing money. Okay? And of course, guys, not all bonds are created equal. Okay, as we will see now. So let's say Globe and Dito promises monthly interest payments. So you notice, guys, that the tenor of the bond are the same. The principal is 500. It's 10 years, monthly interest payments. Now, one of them issued a 7% bond. The other issued a 7.2% bond. Okay, I'd like you now to chat, guys, to write in the chat box, which company issued the 7.2% bond? Okay, let's have a few seconds for that. Okay, go, guys. Which company issued the 7.2% bond? Remember, bond is an utang, guys. It's a borrowing. Okay, so which is the company that issued the 7.2% bond? Okay, who'll be the first one to answer, guys? So you can either answer Globe or Dito. Okay. 10 more seconds. Okay. Nobody's taking the lead, guys. Okay. Thank you so much. Okay. So, all right, Charmaine, why did you answer Globe?
Sir, I'm not sure po, pero
It's okay. It's okay. No, guys, no problem if you're not sure, but I appreciate, guys, the courage for you to speak up. No, that's part of the learning. Thank you, Charmaine. Sige.
I said Globe, sir, because I thought that Dito would not be taking a higher percent po since they're a starting company and Globe is
Okay.
already established, sir.
Okay. I think medyo hindi siguro maliwanag yung pag-explain. Okay, let me just clarify. So both of them are borrowing, no? Manghihiram sila. So when they borrow, guys, they will issue this bond and nakalagay doon yung interest na babayaran nila. So one of them issued a bond where they're going to pay 7% interest. The other issued a bond which says that they will pay 7.2 interest. So the answer there is that Dito was the one that issued this bond. Kay Dito ito. Okay? Now, bakit? Bakit? Sino ba mas bago sa market? Which of them, guys, is a new player in the market? Just unmute yourself, please. Of course, it's Dito, okay? I know you answered Dito. No? And which of the company does not yet have a track record of performance? Of course, it's Dito. So as far as creditors are concerned, as far as those banks who will lend money is concerned, okay, in which company are they going to assume a greater amount of risk? Of course, we know that they will be assuming a greater amount of risk with Dito. Since they will be assuming a greater amount of risk with Dito, then they should be compensated for the additional risk that they'll be getting. Okay, so for example, if I'm Metrobank, okay, and then will I invest in Globe or in Dito if they both issue bonds? Globe issues a bond that's 7%, and Dito also issues a bond worth 7%. Okay, of course, Metrobank will perform due diligence and they will say, why will I invest in that bond? Kay Dito, 7% lang yung return niya, interest. Si Globe 7% din, dito na ako kay Globe. Kasi mas capable si Globe magbayad, guys, because of its track record. Globe had already issued several bonds in the past, and it has been shown that they're able to pay their obligations as they fall due. So if both will be just issuing a 7% bond, then chances are people will or institutions will loan to Globe and not necessarily to Dito. So Dito has to price its bond. It has to provide a greater amount of interest. No? Okay, so I hope that's clear, guys. No? Investors are willing to take on additional risk if they will be compensated with additional returns. Okay, that's why the company here that issued the 7.2% bond, assuming pare-parehong tenor, guys, 500 million yung debt, yung bond, 10 years to pay, and monthly interest payments, pareho exactly the same tenor, then most probably, guys, it's Dito that issued the 7.2% bond, and Globe was the one that issued the 7% bond because of the principle of the higher the assumed risk, the higher should be the required return. Okay? Is that clear, guys, so far? Paki-chat naman, please, kung clear yung explanation natin dito sa risk and return. Thank you so much. Okay, yeah, salamat ha. Salamat sa ano niyo sa guys. I asked that because I want also to be reassured that I'm able to explain the lesson well. Kasi pag hindi kayo mag-respond guys, hindi ko alam guys, and that will be very difficult for me. Okay. Do I need to repeat a certain concept here? Okay, am I talking too fast? Am I explaining too fast? Remember, although naghahabol ako ng ibang slide, it's because there are other lessons that we need to study. But guys, hindi yung number of slides ang be all and end all natin dito. If there's a concept that you would want me to further elaborate on or to explain, I'm gladly willing to do that. Okay. All right. Number 4. Number 4 is the efficient market hypothesis. So market prices are generally right. This is very important, guys. And this is called the EMH, the efficient market hypothesis. We don't have much time to discuss this, but I hope, guys, that you'll be encouraged to research on what the EMH is. Tatlong klase yan, no? Tatlong klase. One of them is semi-strong, strong, etc. Now, the efficient market hypothesis is very important because it says there in any market, the prices of the assets, whether it be stocks or bonds, fully reflect all available information. Okay, imagine guys a scenario where in the market, alam natin na yung price ng asset na yun, it does not reflect fully available information. In other words, guys, there are some parties that are privy to some information that we're not. So pag ganun guys, may mga favored na na mga stakeholders. Sila lang yung may information na yun. Okay? So in that case, I would rather not trade in that market because I know that I will be shortchanged in as far as information is concerned. Kaya nga, for example, the Philippine Stock Exchange, very important yung disclosure. So for example, when Jollibee was about to acquire Coffee Bean, that has to be there has to be an announcement about that. Hindi pa pwede yung some parties only are the ones who know that, and based on that information, they will make certain decisions about their investments in Jollibee. It has to be, guys, the market has to be transparent, and that's what we call the efficient market hypothesis. Generally, guys, prices should reflect the value of the stock. Okay, so there's a distinction between the value of the stock and the price of the stock. When we say prices, it's the amount an investor is willing to pay for that. When we say value, it's actually the intrinsic value. So this is based on the computations made by financial analysts. And financial analysts make use of what we call valuation. Okay? And usually, guys, may mga inefficiencies sa market, although hindi naman grabe, tolerable naman yung small inefficiencies. Okay, that may distort the price of the stock. No? For example, let's say, okay, I'm sharing this with you. I'm going to share these slides with you. For example, let me go to that site. So in this site, guys, investing.com, okay, you can find here, for example, meron tayong basket, yung Philippine Stock Exchange, and it's composed of companies that are best in their specific industries. Ito yung 30 companies na yun. No? 30 companies. So andyan si Aboitiz, andyan si Ayala Land, BPI, sa mga banks, si BPI, si BDO, andyan din si Metrobank. These are the best companies there. Sa food service, andyan si Jollibee, okay, and others, no? And others, si Mega World, sa real estate. Okay, and the prices here, for example, si Aboitiz daw, ang last price niya, 49.95. So ako, kung investor ako, gusto kong mag-invest sa Aboitiz, I know that the price here, stated here, reflect already all the necessary information. Kasi kung may mga hidden information pa pala yan, hindi ako mag-i-invest sa market na to. I won't be investing in this market. So for example, Globe, the price of Globe now is 3042. The price of Jollibee now is 228.4. So let's illustrate that. 228.4, yun ang price ni Jollibee. So that's how much an investor should buy Jollibee in the stock market. Okay, so that's 228.4. Okay, hindi lang ha. Okay, let's write that 228 Mhm. Sorry about that. Okay, 228.4. That's the price Jollibee is now selling on the average in the stock market. Okay, so let's suppose a financial analyst came up with a study of Jollibee, and the financial analyst came up with a valuation of Jollibee. Let's say the valuation is, it turned out that based on the computation, the valuation of Jollibee is 232. Okay, ito yung tinatawag natin, we call this the intrinsic value. That's the worth of Jollibee. And the stock market is selling at 228.4. So we say, guys, that the price of Jollibee based on this study is undervalued. Undervalued siya. Kasi yung value talaga niya is 232, but it's selling only at 228 in the market. So what will be the advice of the financial analyst? Buy Jollibee kasi undervalued siya. So that's what they do, guys, yung mga financial analysts. No? Okay, let's suppose that in the market, it's on the other hand, 235. Okay, so pag 235 naman, on the other hand, and then based on the computation, valuation, then there are several valuation techniques, guys. Yun ang role ng finance, guys. So later on, if you pursue finance, later on, that's one subject there, valuation. Okay, where you learn how to value the asset. Okay, very interesting. This subject is very interesting. So 235 yung sa stock market. But the value of Jollibee is at 232. So what happens now? We say that the stock is overvalued, and the advice would be hold on. Wag muna ibilhin. O kaya kung may stock kayo ng Jollibee, pwedeng ang suggestion ibenta mo. Okay? Kasi now at the market is 235 when in fact the intrinsic value only is 232. So that's one. Time na pala, guys. Guys, okay lang ba? May I have 2 minutes? May I have your permission just to finish the slides? May I, guys? 2 minutes lang, please. Okay, salamat, no? Okay, lastly, guys, is the agency problem. When we talk of agency problem, sabi natin, problema yan ng managers at saka ng shareholders. Because the managers might do things that will benefit them, but not the shareholders. So that's what we call the agency problem. Okay? So sa agency problem, usually ang ginagawa dyan, company comes up with what we call the ESOP. No? It's not writing. ESOP. What's the ESOP, guys? Is it not writing? ESOP. Okay, let me just type it. ESOP. That's the employee stock option plan. Employee stock option plan. So in order to prevent or to mitigate against this agency problem, companies will usually do with this ESOP. In other words, guys, gawin yung owners, yung employees, give them the chance to buy the stock for them to become shareholders. If they're shareholders themselves, then chances are they will not do things or they will be prevented from doing things that will harm the company. Okay, so last 2 or 3 slides, guys. Okay, number 1, corporate finance is really common sense. No? Common sense, guys, na we should invest in a project where the returns is greater than the cost of capital. That's common sense. Number 2, common sense, guys, na it's better to have a financing mix that costs 12% instead of 13%. Remember, financing is the cost of getting funds. So if you're able to get a WACC that's 12% as compared to 13%, that's a lot better. Common sense, guys, then nagsasabi na when there is not good investments, then it's best to return the cash to the owners in the form of dividends. Okay, so this is investment decision, financing decision, and dividend distribution decision. Okay, then also, finance is focused. It's not only, sabi natin sa una, it's common sense, it's also focused. So the objective is singular. Ibig sabihin, is a main objective. Maximize shareholder value. Again, not to demean customer satisfaction, supplier satisfaction, etc. Pero ang one main objective, when we say my main objective, the company should come up with the right investment, the right mix of debt, and the right amount of cash to distribute to the owners. Yeah, right investment, right mix, and right amount. And it can only be right if they follow the principles of finance that maximizes shareholder value. Right investment means the return should be higher than the hurdle rate. Right mix should be, your mix of debt and equity should maximize shareholder value. Right amount of cash to distribute to owners, that's dividend distribution. Okay? And lastly, guys, the principles of corporate finance is universal. Ibig sabihin, kahit small firms, big firms, US firms, foreign firms, companies in the mature industry or emerging market, pare-pareho ng objective yan. And that's to maximize value. Okay? So, for example, yung mga publicly traded or yung mga private businesses, they might have different access to capital markets. Pero iisa lang yung objective nila, is to have this financing mix that minimizes the cost of capital. Okay? A firm, guys, may be in the emerging market or it may be in developed market, pero iisa lang din yung objective niyan. Dapat yung investments nila, dapat they should, the IRR should be greater than the hurdle rate. Okay, and this is the last slide, guys. It's finance plays a major important role because of the situation now. Volatility, uncertainty, complexity, and ambiguity. I want you guys to read on this. That's how the environment is now. Volatile, uncertain, complex, and ambiguous. All the more it calls for a solid finance, corporate finance role in a business. Okay, so with that, guys, I'm sorry, guys, for having to